Hey, Catching Up to Five. This is Bill Yount coming to you to let you know that we got a two-part episode coming your way. This week we have Frank Vasquez, and we're going to talk about bonds. Are they dead? Are they in a bear market? Is it buy? Do we need bonds? Is 100% stocks the only way forward? Well, I think bonds are misunderstood, and it's time to help folks really understand what they are, how they work, and where they can be applied to a portfolio, especially in retirement when we're all about wealth preservation. So the first hour of this talk leads us into this, and next week we'll have part 2. So I hope you enjoy learning about bonds from my friend Frank Vasquez.
The main thing about a bond fund is it's priced every day at a market price, so you can go look it up. If you were to price your individual bonds, though, you would see the same fluctuation in your individual bonds as in the bond fund. The thing is, most people who are holding bonds are not out there pricing them. The longer term bonds will move more in value, so in capital value. I'm not talking about how much they're paying. I'm just talking about if you were to buy and sell them on the market, more than that. And that is very unhelpful when interest rates are going up, but it's very helpful when interest rates are going down.
Welcome to Catching Up to Five, a podcast on mindset, money, and life for late starters of any age on their journey to financial independence. I'm Bill, and I'm a late starter.
I'm Jackie, and I'm also a late starter, and we're your host. We're here to help you on your journey to financial independence, no matter where you're starting.
We're going to talk to experts, other late starters, and explore topics related to our mission.
Join us as we catch up to five together.
Hello, and welcome back to Catching Up to Five. Get ready for another engaging conversation with repeat guest Frank Vasquez, who is named after a hot dog. He is the nonsensical, raving mastermind behind the eclectic and often irreverent podcast, Risk Parity Radio. With a background as an engineer, lawyer, and a lifelong DIY investor, Frank, or Uncle Frank as we know him, combines analytical prowess with storytelling and an odd sense of humor. In an unmistakable laugh, cue the laughter, while waxing poetic about the golden ratio. Today, he's here to help us navigate the world of fixed income and bond investing in particular. We'll answer the burning question, are bonds dead? Just like equities were in the 70s? So buckle up for a lively conversation that promises to be both informative and entertaining. Let's dive in. Welcome back to Catching Up to Five, Frank.
Thank you. It's good to be here again. You seem to invite me back. I must be doing something right here.
Well, I mean, you're a correspondent or a bad penny that just doesn't go away.
Maybe like Homer Simpson.
But I've wanted to, for a long time, try and create sort of a primer or a primer, as it would be, for bonds, which are much misunderstood, maligned, and discarded as an investable asset, especially today's FIRE community that's 100% equities and die, as opposed to die with zero. Die with 100% equities is more the moniker. And there are those of us that don't ascribe to that. And in order to understand diversification in retirement drawdown portfolios and somewhat risk mitigation and accumulation, you need to understand this asset class of fixed income or bonds. So let's start with the fundamentals. What is a bond, Frank?
Well, it's basically a contract. You have the issuer who issues the bond. The buyer is essentially loaning money to the issuer and will pay interest on the bond as long as it lasts. It tells you on the bond how long it's going to last, what the interest rate is going to be, when the payments are due, and all of those details. But in its simplest form, it's usually payable every 6 months or so. And then at the end of the term of the contract, the money goes back to whoever bought it or the lender. It's a debt instrument, basically.
Well, in the old days, we actually had paper bonds that had coupons on them, right? And you would rip off the coupon to get your interest. This is our parents' and grandparents' days, right?
That's correct. That goes all the way back, at least to the 19th century, that it was important to actually keep those things in a safe place because you had to clip it and take it down to the bank or wherever in order to cash it in. It was that formalized.
So when you are the bondholder, you are basically the bank, and somebody is indebted to you and paying you interest throughout the term of the contract, and you get your principal at the end. You are not an owner of the company or a shareholder. There's no equity. It's completely different from a stock or an equity, right?
That's correct. The only thing it really has in common, at least in modern times, is that you can buy and sell bonds like you can buy and sell shares of stock. And the value of a particular bond does fluctuate based on the interest rate, mostly of the prevailing interest rate. Because if you buy a bond at a certain rate and it's paying 5% and the prevailing interest rates go up to 6%, your bond is worth less money if you were to try to sell it.
Yeah, we're going to get into that because that's a key element of bonds that you need to understand. But functionally, there are three pillars of utility, we say, with regards to bond. There are three roles they can play in our portfolios or in one or more at the same time. What are those three, Frank?
They're generally income is usually what people are thinking of. They're thinking of the income that comes off the bond. But in terms of using them in a portfolio, they can also be used as a stabilizer, at least if they're the shorter term bonds, and or they can be used for diversification. And different bonds have different correlations with the stock market. Some are highly correlated with stocks and some are less correlated with stocks.
We're going to get into some definitions in a minute, but fundamentally, just to reiterate, they are for stability, diversity, or income. And they're used for those purposes, one or more at the same time. My mother, for example, thinks about, I just want to have the highest interest rate because I'm just living off the interest and I'll get my money back at the end. And there's a lot of moving parts in there that people don't understand, especially with regards to interest rates and inflation and bonds. But bonds are not the only form of fixed income. And we'll need to back up a little bit and say, what other forms are there of fixed income?
You have your bank products, of course, and your savings account is a source of fixed income, if you will, or things like certificates of deposits, or you could get income out of rental properties or REITs or something like that, or even insurance products, annuities can be used for income. A lot of different things will pay income. You do need to remember, as we're talking about this, that the first word after income is taxes. So that should always be in the back of your mind when you're thinking about whether you should buy an income product and where you're going to put it in terms of which account it should go in. The other general characteristic about bonds, at least most bonds, is they're known to be basically low return and lower risk than equities. So if you look at equities as just the whole stock market over the course of, say, the last 100 years, the returns are somewhere between 10 and 11% nominally, and the volatility of it is somewhere up around 17, 18%. When you're looking at something like an average bond, if you're like a Treasury bond that's an intermediate term bond, the returns generally are about 4 to 6% nominally over decades of time, but the volatility is much less. It's like half or less than stocks. That is why people have traditionally paired them with stocks in various configurations and portfolios. You definitely do not think of investing in bonds to get great returns or fabulous returns out of them. You need to take more risk in equities. There are really risky bonds, high yield bonds and things like that. I don't think any of us really needs to be dabbling in that. That's for the professionals, but that's junk bonds is what they used to be called. They're called high yield bonds now. They carry the same kind of risk characteristics as stocks in a lot of circumstances.
Yeah, I mean, that's important. The bond universe is in some ways much larger than the stock or equity universe and more complicated. And
that's true.
Sometimes difficult to understand. And most of us think of bonds as either the income or the stability, emotional hedge in a portfolio to avoid panic selling at times of equity distress. Okay, let's walk through then the main classes of fixed income with regards to bonds. Tell us what treasuries are.
Okay. Well, we're talking about U.S. treasuries. Every country issues its own bonds, and some of them are very risky and some of them are not risky. The U.S. Treasury is considered the, quote, riskless asset, or the asset with the least risk of any financial assets around the world. And so these are bonds. And they're actually categorized as bills for the shortest term, notes for up to 10 years, and bonds after that, even though they're all essentially just bonds of different maturities. But these are issued by the federal government and the lifeblood of worldwide finance, that every country holds U.S. bonds, every major investor, every bank across the world holds U.S. bonds as part of their reserve assets, essentially, usually of various durations. The bond world is mostly held by banks, insurance companies, and other large institutions. Where individuals fit into this is a tiny area over on the side, because we're not using them the same way that a bank would be using them. But treasury bonds are bonds issued by the U.S. government.
And then actually, according to the 14th Amendment, they have to be paid back, right? They're guaranteed by our own Constitution.
That is correct. One of the most interesting things about the 14th Amendment is after the Civil War, there was a debate over both the Confederate debt and the Union debt, and as to what debt would be repaid, who would be repaying it. The 14th Amendment, there's an insertion in there to resolve this issue, and it basically said none of the Confederate debt will be honored, but all of the Union debt will be honored. But it's written in a way that all U.S. debt will be honored, like going forward forever. That means you get U.S. dollars back. It does not mean you get gold or something else like that back.
Gold! Oh, no, we can't go there today. We did another episode on that.
There's a series of cases called the Gold Clauses cases where this was actually litigated in the early 1930s, but I don't think you want to go there.
Well, don't cross-examine me on that today, because I know nothing. But that piece of history you mentioned, actually, in bond history, there's Hetty Green, right, that really benefited from this 14th Amendment in a big way and made a killing in bonds, right?
Yeah, well, she speculated that the Union bonds would be repaid, and so she bought a whole lot of them at a discount, 20, 30 cents on the dollar. And then once the 14th Amendment passed and they were guaranteed to be paid, the value of those bonds shot up back to par, and so she made a killing on that. Hetty Green was known as the Witch of Wall Street, and she was as good an investor as Warren Buffett was. And she was active from essentially around the Civil War right after that, all the way through to the early 20th century. But there's lots of stories about her. If you're interested in how finances worked in the 19th century, that's a very interesting read.
Well, didn't she wear all black, and wasn't she a little bit scurrilous and ended up broke maybe at the end of life, right?
No, she was not. She did not go broke. She died with an incredible fortune which her son Ned happily spent. She was known for being a miser, is what she was mainly known for, is not spending money, which is why she got this reputation, because she would wear black and not spend much money. And she had an office in the chemical bank in New York where she sat there and clipped her bonds all day long. She made all kinds of investments over many years.
So she was the original boglehead then, wasn't she? She was the quintessential hoarder.
She was. I mean, the Guinness Book of World Records used to list her as the #1 miser in history.
Okay. All right. Somebody not to aspire to.
But I will say a lot of this, I think, was because she was a woman in a man's world, and that world was not very kind to women. So I think if she were a man, she would have had a different reputation, like corporate raiders of the 19th century. A lot of why it's interesting to read that history is to think about her being a woman in that environment and how might she have been written up if she was a man.
Actually, that's a very good point.
Because I think he was the best investor ever. I mean, it would have been this kind of glowing Warren Buffett kind of.
I completely agree. I mean, if you flip that, she's a genius, right?
Yeah.
So at any rate, we've talked about treasuries, and we'll get into durations and yields to maturity and other stuff there too. But the next class of bonds I want to out here is corporate bonds. Tell us about those.
Okay, these are just bonds issued by corporations. If Apple issues a bond, it's going to be pretty highly rated, and they can give you a lower interest rate than some fly-by-night company or some company that is in danger of bankruptcy. So you'll get different levels of interest rates depending on the credit worthiness of the company. And they rate those bonds. They go generally from A's to C's, and C's being the junk bonds. But corporations issue debt all the time as part of how they run their company. You can issue stock, you can issue bonds, or you can issue other kinds of instruments. But that's another way that corporations raise money.
Yeah, and there's always a capital stack, right? If you loan money to a company and you're higher in the stack with regards to the level of debt you provide them, if they go bankrupt, are you going to get your money back?
There's a hierarchy in bankruptcy of who gets their money back first. A bond holder is not a secured debtor. A secured debtor is like a mortgage holder or a lien holder. They would get paid first. Then you're looking at unsecured debt like bonds, and then the equity holders come last. In a lot of circumstances, often what can happen in a bankruptcy is the bondholders end up owning the company because they basically take out the shareholders. This is usually negotiated at a high level, but it's often the case that the bondholders are made partially whole. People who really trade bonds are all into dealing with what they call distressed debt, a company that bonds are undervalued because there's a danger of bankruptcy and a danger of them not getting paid. But if you buy those kind of bonds and the corporation makes it through the bankruptcy or becomes solvent in some other way, you get a big payout. But that's a method of speculation in bonds. I wouldn't do that if I were you and I.
Yeah. Well, so basically, the higher risk the debt, the higher the interest rate they have to pay in order to justify the risk of that bond. And then that goes all the way down to the U.S. debt, where it's the most secure and generally probably lower interest rates.
Yeah. So if you look at a 10-year Treasury bond versus a similar bond from Apple, that'll be a slightly higher interest rate. And then some company on the verge of bankruptcy is going to be a much higher interest rate in terms of all three of those bonds. But that interest rate is telling you something. It's often referred to as the spread. When people are talking about the spread between corporates and treasuries, they're talking about what is the difference between an average corporate bond and a treasury bond. And that's something you may hear on CNBC or when people are talking about these things.
Okay. And the next class of bonds that's pretty common out there and you don't often hear about in our world is municipal bonds. And they are a particular type of bond and have particular roles maybe in somebody's portfolio as well.
Yeah, they're issued by cities and states. They are small sovereign entities. And the main value of municipal bonds is typically they can be tax deductible at the state level and at the federal level. And so they are often popular in high tax states like California or New York. They are most useful to people who are in very high tax brackets and that are forced for some reason or another to hold bonds in their taxable accounts because of the tax deduction or the fact that you don't have to pay tax on the income. On the other hand, because of that, they generally pay lower rates than other kinds of bonds that are not tax exempt. I should say U.S. Treasuries are state tax exempt, but not federal tax exempt. But municipal bonds are known for this tax characteristic. And they typically are honored. There are instances, though, of cities or municipalities not being able to pay their bond debt.
Yeah, I mean, they're a little more secure because they can raise taxes to pay their bonds too. So they're a little bit backed by the ability to increase the tax base. The other thing is, how do you compare an interest rate paid on municipal versus a treasury or other bond that has sort of an ordinary income tax treatment?
So you would need to look at the ordinary bond and think of, okay, if this gives me $100 in income next year, how much am I going to pay in taxes on that? Basically your highest marginal rate. So if you're in the 22% tax bracket, and let's pretend you don't have any state taxes for this, So that's the equivalent money you'd get out of that would be $78. But if you had the municipal bond, you'd get the whole $100. Then you need to compare the interest rates of the two of them. What this tends to result in is that municipal bonds seem to be really valuable for people in the highest tax brackets, like the 37% tax bracket. And if you have a big state tax on top of that, they're not that useful for people who are in 12, 15, 20% tax brackets because they are priced essentially as if you are one of those highest taxpayers. And those are the people that they're really sold to for the most part.
Okay, so not something that's in our wheelhouse necessarily in our community, but another tool in the toolbox, so to speak. Now let's jump into your favorite bond topic known to man, and we'll circle back to this, tips. You were a tips lover, then a tips hater, and you've had some very famous rants on your podcast about tips in particular. It probably needs its own kind of video clip, but let's keep it clean for the moment. On what are tips and when were they brought to the market and what are they supposed to do? And then we'll get into later, what do they really do or not do? And are they misunderstood?
Okay. TIPS stands for Treasury Inflation Protected Securities. They're a form of Treasury bond that was issued starting, I think, in the late 1990s is when the first ones were issued. But they are issued alongside of all the other kinds of bonds that the U.S. Treasury issues. So they have some inflation protection built into them, but it's not free. So if you look at a Treasury bond, an ordinary Treasury bond, it's called a nominal bond versus a TIPS bond, and say they're both issued today and they're both 5-year bonds or notes, I guess is what they would be. The Treasury bond, the nominal bond, will pay something like around, 4% interest. Let's just say it's 4% for the purpose of this. The TIPS bond will have an interest rate of something like 1 to 2%. What you get out of that is you get the 1 to 2%, and then every year they use an inflation measure and they add that on as interest that goes on top of it. So basically you're betting, if you're picking which one you would want, if you think that inflation is going to be lower than what people are predicting, you would buy the nominal bond and you'd get the 4%, because if the inflation is only 2% and you're getting 1% for the tip, and then it's only paying you 3%. But if you think inflation is likely to be higher in the future over the term of the bond, then you might want the TIPS bond because it would pay you for the extra inflation, if you will. So they are really designed to be a bond that essentially gives you this inflation protection. But the cost is that the nominal rate on it is much lower because it's essentially the difference between that interest rate on the TIPS and the interest rate on the nominal bond. That is what the market thinks inflation is going to be. It's an estimate of the market of what they're willing to pay for just a straight bond or one with inflation protection. And so that's how they basically work. So over time, they give you a variable interest rate depending on what inflation is and what their stated rate is.
And you can buy these, interestingly, especially with regards to treasuries and tips, you can buy them from the market, the secondary market, or you can buy them from TreasuryDirect too, direct, and have an account at the federal government, right?
You can go to TreasuryDirect and open an account there and buy all kinds of bonds straight from the U.S. Treasury. Their website is terrible, I can tell you that. I've had one of those accounts. But the way most people buy bonds these days is in funds or on a secondary market, because you can also buy all these bonds through brokerages. And there are many funds now, like Vanguard has a whole suite of funds that you can buy short-term treasuries and intermediate-term treasuries and long-term treasuries. You can buy the short-term tips and longer-term tips. There's a fund for everything now. That didn't used to be the case 20 years ago, but today you basically can buy the specific ones you want, and you don't have to buy like a whole basket of them. Like a total bond market fund is a whole basket of bonds, but it's not actually all of the bonds. It's misnamed.
All right, we're about to jump into this because we're getting into this bond alphabet soup and terminology, and that is our next topic. So let's circle back to basically the vocabulary of bonds that we need to understand, just like David Stein does with his 10 questions. You've got to ask, with this asset, you got to go through these questions of what are all these things and do I invest in it for my portfolio? But the first definition I want to throw out there is maturity. Let's talk about that.
Okay, maturity is just the date by which the bond needs to be repaid. So if it's a 5-year bond that's issued, there will be 5 years of payments, and then they'll give you your principal back. And so the maturity is 5 years. And so each bond generally has a stated maturity on it. It is possible to have bonds with variable maturities too, but let's just keep this simple, that the maturity is basically what it says in the bond if it's a 5-year bond. Now, interestingly enough, when you think about it, the maturity of a bond is all the time, because you can buy a 5-year bond 2 years into it, but it's really a 3-year bond. But as far as you're concerned, it was a 5-year bond, but now it's a 3-year bond, and it will behave and be sold and bought as a 3-year bond if you buy one on the open market like that. But if you're buying them straight from the Treasury, if you buy a T-bill, a 3 months or even a 1 month T-bill, or you can buy a 1-year bill and then notes and all the way out to 30 years.
Okay. So we have maturity. And then when you talk about the principal, you're also talking about another term we hear a lot, par value, right? What is par? It's not a golf term.
Yeah, par is essentially, if it's a bond for $1,000, that's the par value. It says this is a bond, we're issuing it for $1,000. That is called the par value in the parlance. The reason that's important is really just to compare it with the price you would pay later on. Because depending on how, if a bond is issued at $1,000, say at 5%, and 6 months later, interest rates go up, and so new bonds are paying 5.5%, that your bond will be worth less than par. So it'll be worth something like $970 or something like that instead of $1,000 if you were to sell it. On the other hand, if interest rates were to fall, say 4.5%, then the people would prefer to buy your bond from you that pays 5% than the one they can get from the U.S. Treasury at 4.5%. And so your bond would go up in value just to normalize those two interest rates, because there are always new bonds at every maturity coming off the rack, if you will, at least the Treasury bonds. And so you can always buy the new one, which is called on the run, or you can buy older ones. But the par value is just that stated value on the bond itself.
Okay. Now, we were just talking basically a little bit about duration. And that's a term that's critical in understanding bonds. And this is, as I understand it, a measure of how sensitive a bond's price is to interest rate changes. Is that correct? Take us through a duration example and definition.
Yeah, okay. Yeah, that's the definition of duration. It's related to maturity, but it's not the same thing. And this has to do with the fluctuating price of the bond that I told you about. That if a bond has a maturity of 5, 10, the longer the maturity is, the longer the duration it's going to have for the most part. And that duration basically tells you how sensitive it is to interest rates. So if you have a long-term bond with a duration of 10 years, say, and interest rates go up from the time it was issued, say interest rates go from 5 to 6%, the value of that 10-year bond, if that's the duration, will go down by about 10%. So that's telling you, the duration kind of tells you what is the multiple as to looking at the stated interest rate from the market as to how much in value this bond is going to be going up or down. A longer duration bond is more sensitive to interest rates. And so a long-term bond can go up or down in value by 10 or 20% when interest rates are really moving. Whereas a really short-term bond, it's going to fluctuate 1 or 2% if it's like a 1-year bond or a 2-year bond. So the duration impacts how sensitive it is to interest rates, both on the positive side and the negative side. And this affects more how bond funds are priced. It does affect exactly how bonds are priced, but most people who buy individual bonds are not out there trading them because it's been cumbersome.
Yeah, we're going to get into that when we talk about the difference between individual bonds and bond funds, because people think, oh no, my money's secure. I bought this 10-year bond. I'll get it all back in 10 years. I may be losing out to inflation. I'm going to get my interest rate. But if they need the money in 5 years and interest rates have gone up significantly, guess what? You're not getting your principal back anymore because the value of that bond has dropped. And the principal value of these bonds do fluctuate, even if in your mind, your mental accounting is that, no, at maturity, I get it all back. But in between, not necessarily.
It's an illusion between, sometimes people think that holding an individual bond is fundamentally different than holding it in a bond fund. The main thing about a bond fund is it's priced every day at a market price. So you can go look it up. If you were to price your individual bonds, though, you would see the same fluctuation in your individual bonds as in the bond fund. The thing is, most people who are holding bonds are not out there pricing them. But if you had your 10-year bond and you decided, oh, I actually need all of the money out of this bond, I need to sell it in 5 years, you would have to go out and get a market price for it. So the actual value of your bond is fluctuating, even if you're not actively trading it.
Yeah, it's kind of an illusion. And we're going to circle back to that. An article by Ben Carlson that you quote often talks about this, because bond ladders and buckets and flower pots, as you love to talk about, become an issue when you start to talk about financial advisors, et cetera, et cetera. You can hear the milkshake.
I drink it up, Bill. I drink it up.
So, listen to Risk Parity. You'll see what I mean. At any rate, another term that we need to define probably is yield to maturity as well, so that people understand when they hear that thrown out with regards to bonds. Can you take us through that definition?
It's reflecting kind of the aging of the bond. Technically, it reflects both the interest payments and any gain or loss between the purchase price and the par value. So it's a method of valuation. I'm not sure how useful it is for.
Maybe it's just a term we need to understand that's out there. We've done some bonds 101.
It's a point of comparison between two bonds is what it's used for.
Another thing that people always talk about that we need to understand is this proverbial yield curve. Now, there's a whole book that can be written on this, but what does our community need to understand about the yield curve?
Okay, each bond, if you think of all the bonds in their line of maturities or durations, you can line them up and you can do a little graph where you have your 1-year bond and you have it at its interest rate and maybe it's at 3%. And then you go out to the 2-year bond and it's 3.1%. Then you go out and you put your longer term bonds on the graph. And so if you draw a line between all those points, that is the yield curve. And it usually is kind of a curve, but it's basically reflecting how the bonds relate to each other that are of different durations and maturities on a graph. Ordinarily, the yield curve goes up. So the longer the duration and maturity, the higher the interest rate paid by the bond. It is possible, though, for the yield curve to become flat, that they're all paying about the same. And it's possible for you to have an inverted yield curve. And that means that the shorter term bonds are actually paying a higher interest rate than the longer term bond. So that's when people are talking about a yield curve, that's what they're talking about, is the shape of that graph.
Now then, people use the yield curve as a Sonia crystal ball sometimes. And there are things that can mean, doesn't always mean. When people talk about an inverted yield curve, what are they getting nervous about?
Okay, there was a long history of whenever there was an inverted yield curve that forecast a recession within the next 6 months to 2 years. That actually broke down in the last cycle when we were coming out of COVID, and then what happened in 2022, that there was an inverted yield curve, but it did not result in a recession. So the indicator failed in its last round. And that is often true of these tried and true indicators. They work for a while and then they don't work. And that's why you never want to be too trusting of anybody's crystal ball or their metric. But That's what financial media is full of, is people looking for the next crystal ball and trying to forecast the future. And so the yield curve is often talked about as being a forecaster of something. Whether that something comes true or not, sometimes it does and sometimes it doesn't.
Yeah, I mean, these complex adaptive systems and interest rates that people think they can predict and they're going to go up and they're going to go down. You can always consult with Frank, because I believe someone gave him his own crystal balls.
You actually gave me two, Bill, for Christmas. A black obsidian one and a calcite one.
One's bigger than the other, isn't it?
Yeah, I should have brought them today.
Oh, you don't have them with you today. All right. So we're going to challenge our audience here today with another bond term that gets thrown out there. And this may be for bonds 202, 303, but it's not always a linear between interest rate and capital cost or par value of a bond. It's not linear. There's something called convexity when we talk about bonds. That confused me for a long time until I started digging into longer term bonds and understand how they operated at extremes of interest rate. Give us the bullet definition of convexity and why is it important to understand with regards to bonds?
Okay. Remember how I was saying that? So if we go from an interest rate like 6% to 5%, bond with a 20-year duration, if you went from 6% to 5%, it would go up 20% in value because it's kind of the multiple there. As you get closer to zero, that relationship gets distorted, which is the convexity part of this. So if you're going close to zero, like we did 10 years ago in the aftermath of the great financial crisis, when they kept lowering interest rates, those long-term bonds did go up a whole lot more in value than you would have expected just by going from one point of interest to another one. The convexity means it gets curved and distorted when you get close to zero in this kind of relationship, whereas it seems like more of a linear relationship when you're talking about interest rates like 4, 5, 6, 7%, that you can just say, okay, it goes up or down 1%, and we know what the duration is. You just multiply the 1% times the duration, and that's likely how much the value of that bond is going to go up or down. When you get close to zero, it gets distorted.
Yeah, I mean, it accelerates kind of, doesn't it?
Yeah. Yeah.
You can really see some big jumps. And what you just told me, I don't know if people heard, but bonds can go up 20, 30% in a year. That's like the stock market. What are we talking about? People think bonds don't move this much. And tell us why that is and how that becomes, we'll get into why it's important later.
It's all in this duration, that the longer maturity and longer duration bonds, because you're talking about an income stream that goes out 20 or 30 years. The value of that income stream, because it's a much longer period of time than, say, a 2-year bond, is going to fluctuate a whole lot more. The market is always repricing every bond, comparing its stated interest rate to what the interest rate is in the market if you were to buy a new one of those today. So as a consequence, the shorter term bonds are more stable. They don't go up or down as much. The longer term bonds will move more in value. So in capital value, I'm not talking about how much they're paying. I'm just talking about if you were to buy and sell them on the market, more than that. And that is very unhelpful when interest rates are going up, but it's very helpful when interest rates are going down. And when interest rates are going down, usually the reason they're going down is because there's a recession. That is one of the primary reasons people say, well, bonds are diversified from stocks. What they're really thinking in their head is that when there is a recession, my bonds are going to go up in value and my stocks are going down in value. And the longer duration you have, the more those bonds will go up in value in the recession scenario. So that's sort of how that works.
Okay, yeah, we'll get into that a little bit more because diversification becomes a critical factor in correlation when we talk about retirement drawdown. Whenever we invest in something, though, we need to also understand the risks of investing in them. And the risks of bond investing are different than the risks of, say, equity investing. And they're not many, but they're important to understand. We've talked a little bit about some of them, but I think I've listed 5 here that we probably should go through just so people understand what they're playing with.
Okay, which one do you want to start with?
We have interest rate risk to start.
Okay, that's what we were just talking about, that if you have a bond typically pays a stated interest rate, but if the interest rates in the market, the world, are going up or down, if they're going up in particular, your bond is worth less money because people would rather buy a new one from the Treasury that pays 6% than your bond that pays 5%. And correspondingly, if the interest rates in the market go down and you can only buy a Treasury bond from the Treasury at 4%, your 5% bond is worth more because those things need to equal out in value.
And we talked about it with regards to corporates a little bit, and we know that the U.S. government will never default on their bonds, but default or credit risk, who are you lending money to, basically, and how reliable are they, and have they been graded high or low? This is another risk you're playing with, right? Am I going to get my money back?
That's the counterparty risk, that there's always a risk that the person issuing the bond will not pay it or won't be able to pay it. That's why you see, in particular, corporate bonds are rated based on their default risk, essentially, that the highest rated ones, the AAA bonds, have a low default risk, whereas you get down to C's and you have junk bonds, those have a higher default risk, and that's why they have to pay more interest. It's the risk of not being paid back. And that is why people say that the Treasury bond is risk-free, because obviously the U.S. government can always print more dollars and pay you in them. Now, those dollars may be worth less because of inflation, but you will at least get the nominal amount of dollars back that you are promised by the government.
Yeah, you mentioned inflation, and we hadn't experienced that in our lifetimes really until just a couple years ago. And inflation is a huge risk in the bond investment world. And why is that?
Yeah, that is the main risk that you are really facing by investing in any kind of bond, that over time, if inflation is higher than the interest rate, you're losing money, essentially. That's why most short-term bonds, you probably don't want to hold too many of them because you're basically losing all your money to inflation. I talked a little bit ago about how over the course of the last 100 years, the nominal return on the stock market is between about 10 and 11%. After inflation, it is between 7 and 8%. So think of that with respect to a bond. An intermediate bond has a average return of like between 4 and 6%. After inflation, though, it's more like 1 to 3%. If you think of your after inflation return of a bond and it only being about 2% and comparing that to a stock that has an after inflation return of 7 or 8%, you can see that the stock, when you account for inflation, is much more valuable than the bond in terms of its overall return after inflation. It's not the difference between 10 and 5, it's the difference between 8 and 2.
And then we're talking about these assets in isolation. And like in anything in a portfolio, you have to think of them together. And we'll get to that in a little bit. There's one more risk that people may not have heard about that is not as common to hear about, but call risk. And that's not necessarily a problem with treasuries, but that can be a problem with other bonds, right?
Yeah, not all bonds have fixed maturities. Some bonds are what they call callable. A lot of corporate bonds are like this. And so the corporation can issue a bond, say at 5% or 6%. It can say it's, a 5-year bond, but it's callable. They can decide next year, it's like, we'd rather not keep paying you on that bond. We're just going to give you your money back now. We're going to call your bond in. So we'll give you your money back. We're no longer on the hook to pay you any more interest, and we're done. It's basically an option for the issuer to sort of stop the bond term in the middle. It reduces their risk in case there's a lot of interest rate fluctuation out in the market. But from your side, as soon as it becomes too good of a deal for you, it's likely to be called.
Okay.
If it goes up a lot in value, the corporation will say, and I'm just going to give you your money back now. Give me that.
And what people don't realize, too, when they invest in things is they're not sure of the size or the liquidity of the market they're investing in. And I never really appreciated illiquidity risk until I got into, say, a syndication or two. And I'm like, I don't want to have my money locked up like this. And you may hold something that you can't sell. And that's liquidity risk, right?
That's right. Not all financial instruments have a liquid market that you can sell things into. We're used to the stock market and the fund market where you can just buy or sell anything you want every day. If you buy individual bonds, particularly corporate bonds, that is a really messy market to work in. A lot of the bonds in there are not very liquid, which means there is a bigger spread between the bid and the ask price, what you could sell it for and what you could buy it for. And individual bonds are still basically sold by brokers, which makes that market, it's almost archaic compared to the way we work with funds today, where everything is really liquid and the difference between the bid and the ask is only a penny or something like that. These differences can be several percent in the bid and the ask price. You may be able to sell your individual bond, but you might not get a good price for it, is basically what the story of it is.
Man, you have these broker dealers that buy them from the market, then mark them up or mark them down and resell them to you as the secondary market. And I'm familiar with this problem in a family member who has a corporate bond ladder and with a big box broker dealer. And it's just...
Those are very illiquid. And so you're almost like locked into it. You can sell them, but you're not going to get good prices for them. That's always an issue with corporate bonds. And it becomes even worse when you start talking about high yield bonds and foreign bonds and all sorts of other things out there. Yeah, the worldwide bond market is many times the worldwide equity market, actually.
You bring up a good point, actually. And we didn't really mention international bonds, emerging market bonds, all this international bond market. And target date funds, another love of yours, actually, have typically, say at Vanguard, some international bonds in them. And why is that? And what is the point for an American investor, if any?
Yeah, I'm not sure why those are in most target date funds, because I would think that's a very advanced investment because there's a currency risk with respect to any kind of foreign instrument. The difference between the value of the US dollar and whatever currency these foreign bonds are issued in is a major risk and a major fluctuation. And this plays out in odd ways that you would think that a international bond fund would be more diversified from US stocks than US bonds. That's generally not true. Generally, international bonds are more positively correlated with US stocks than US bonds are. And it has everything to do with these currency issues. And so those are very tricky assets, actually, to hold, think about, or use. I wouldn't think most US investors would really have a use for them because they're not as diversified as you think. It's one of those things where it sounds different, but the reality of it is it doesn't work that way. My radar pricks up when people start talking about a separate bond portfolio. You have a stock portfolio and you have a bond portfolio. There's an inaccurate assumption in that going on, which is people think that all bonds have the same relationship to all stocks, and that they don't actually. That a lot of those bonds in that bond portfolio might be positively correlated with your stocks, and some of them might be negatively correlated with your stocks. And there probably isn't a reason why you need a whole suite of bonds, because you're probably not using them for that many things in your portfolio. And just as a rule, they're going to be lower yielding overall than the stocks. And so you're not really holding them for their return profile. So then you need to think about, why do I have this and what purpose is it serving? And maybe I should just hold the ones that actually fit my purposes and not just every one I can think of just to have.
You bring up a couple good points here, and people generally don't understand, in my opinion, the term diversification. And a lot of them have never heard of the term correlation, which is a number. And you can define this number in certain ways. DIYers can do this. Take us through real quick your definition of diversification, because it's not just, it's international so it's different than investing in US. Just because it has a different name, total international versus total US. Well, is it really different? Or is it diversified? I mean, maybe not. Take us through what you mean when you say diversification, and then subsequently, what is correlation and why is that important?
Okay, essentially, when you're talking about two assets, if they're diversified, they should not be moving together. The more they are moving together, you would say the less they are diversified. Now, it's possible for them to move in opposite directions, but it's also possible to have what they call zero correlation, in which case there's no relationship between the way one moves and the other one moves. So in order to measure that, you generally use something called a correlation number, which is basically you look at the history of these two assets. And you can actually go to a place like Testfolio and put in two funds or two assets and bring up a little correlation matrix, and it'll tell you. And it gives you a number between -1 and 1. And the higher the number is, the more positively correlated, or the more the assets tend to move together. If it's close to 0, that means they move randomly. And if it's negative, then they tend to move in opposite directions most of the time. So that's how you want to think about diversification. That the first thing you want to think of, if they give you two assets, asset A and B, and they ask you, are these diversified or not? You can't tell that just by looking at the names of them. You have to go and look up and see what the correlation has been. And then you need to ask a separate question, which is, what kind of environment was that data in? Because correlations can change between two assets over time, but they're not random. They don't just change for no reason. They typically change when you enter different kinds of economic environments. And this is especially true with bonds. Bonds can be positively correlated with stocks, or they can be negatively correlated with stocks based on the macroeconomic environment. I'm specifically talking about Treasury bonds now, because Treasury bonds, of all the bonds, Treasury bonds are the least correlated with stocks. They exhibit that behavior in recessions for the most part. So you can look at the data for 100% of the recessions going all the way back to World War II. Every time there was a recession, that stocks are usually going down and bonds are going up in value, which means they're negatively correlated in that period. But if you're looking at them in an inflationary period or a high interest rate period, you'll see positive correlation. So you'll see that in the 1970s, and you'll see that in years like 2022. And then you might see periods where they're like zero correlation. Right now, they're like zero correlation because bonds are just sitting there. They haven't done much of anything in the past few years, where stocks keep going up. And so they don't seem to have much, if any, relationship between each other. But that can change over time, but it's generally based on a macroeconomic environment. You will often hear commentators or on the financial media, they'll say, yeah, when that happens, all correlations go to 1. What they're saying is that, yes, in kind of a panic crash scenario, like you might have seen in March of 2020 during the depths of COVID, that basically everybody was selling everything. And so it seemed like all the correlations were going to 1. Now, Treasury bonds actually did go up in value during that. The long-term Treasury bonds went up about 20% like right away. But that generally applies more to things like U.S. stocks and international stocks. People think that they must be different because they're from different countries. Typically, if there's a worldwide recession, they all go down together. It's just a matter of which one goes down more. And these
are important things to understand because, as Jack Bogle said, as you've famously quoted many times in chapters 18 and 19 of Common Sense Investing, if you have an all equity portfolio, 90% of those portfolios are going to perform the same because of their volatility. But when you're using bonds and you talk about the macroeconomic environments, we've talked about that a little bit on other shows, but in order to make sure people are on the same page, give us a little bit of that 4-quadrant model, because bonds are operating in our portfolios, in particular Treasury bonds, for their negative correlation as recession insurance in a market where growth is down and inflation is down too, right?
Yeah, this is called a business cycle model or a 4-quadrant model. It's observing that if you look at sort of the macroeconomic weather in the world, there are two things that people are always looking at and talking about. One of them is growth. How fast is the economy growing or shrinking? And the other one is inflation. Are we having higher inflation or lower inflation? What usually they're looking at is not the absolute number, but the direction. Which is inflation going up now, or is inflation going down now? And is growth going up now, or is growth going down now? Obviously, if you do there are 4 possibilities for that. You can have either both go up, both go down, or they're going each in a different direction. But that gives you 4 quadrants. And if you put those 4 quadrants on a map and take a bunch of assets out, you can look at the assets. And if you knew what quadrant was going to be next, you'd be able to market time. You'd be able to say, I know these perform well in recessions, and I think a recession's coming, therefore I'm going to sell these assets and buy those assets. If you knew that, yes, you could be a great market timer. And that is a lot of what people out there who are selling you systems or saying they have magic abilities are trying to do. That's why people are talking about these things all the time, because if you knew for sure that we were going to have a growth period, an inflation period, or a recession period, then yes, we know which assets perform well in each of those environments, and you could buy and sell them and exchange them and outperform the market. The problem is almost nobody can do that, or at least they can't do it consistently. You're much better off as a do-it-yourselfer or an average person just to try to hold assets that are going to at least survive, if not thrive, in all of these different economic environments. That's kind of the basic principle of portfolio construction or diversifying a portfolio.
So historical understandings here, you mentioned market weather, and we've seen weathers over the decades in the past. And we talk about bull and bear markets, but when we say that, we're really referring to equities all the time. Bonds have their bull and bear markets too. We talk about buying the dip. And when we say that, we're talking about buying equities when they're on sale. And that's kind of a quasi-market timing as opposed to just dollar cost averaging our way through the ups and downs. So we're always referring to equities with our terminology, but they apply to bonds. And historically, we see this. Can you take us back in history to a couple of market weathers or decades where bonds were really the cat's meow?
Yeah, the Depression period, one time the holding bonds was useful because it wasn't even low inflation, it was deflation. And so anything that paid you dollars was worth even more. And so if you were holding Treasury bonds in 1929, you were fine. And the longer the duration, the better off you did. That went on for quite a while. Of course, there was a lot of manipulation of interest rates during World War II that is not normal, that they were basically held at a certain rate. But you did see some of that. I think what most people are really more familiar with is the bad inflation period where interest rates were going up considerably in the 1970s. And then after that, going down from 1980 all the way to the great financial crisis. And so the 1970s, really from about 1965 or 66 to 1980, were known as a bond bear market. And after that, there was a bond bull market. But even during those times, the interest rates would fluctuate. And so your bonds would be worth more or less as time went on. And where we are right now is more of a normalish period, more like the 1990s, where the bonds are relatively stable, but interest rates are fluctuating a little up, a little down. And so you see that you'll buy a bond and it's paying 5%. And then 6 months later, the interest rates have fallen and your bond or your bond fund is worth more than it was before because you essentially bought the dip. And if you're just rebalancing your portfolio periodically, you will naturally take advantage of that over time. Bonds are just like any other asset, at least bond funds. They go up and down in value and they fluctuate. They fluctuate less than stocks and they don't always go up and to the right, but they do have the same characteristics basically of sometimes they're on sale and sometimes they're not.
I mean, relative to a few years ago, bonds are quasi on sale because if we think interest rates are going down, then their value will go up. But let's talk a brief bit about, because our most recent experience with this is when correlations went to 1 and bonds had a terrible run in 2022. That did not happen for decades. Tell us a little bit about 2022, because people are going to say, see there, you can't be diversified because look what happened in 2022.
Yeah, that happens, but not very often. It happens about once every 40 years on average. So it's happened about 3 times in the last 100 years or so. What was going on there is there was inflation in the economy. A lot of it was caused by the way the government behaved after the COVID period. But usually what happens then, at least in modern times, is the way that the Fed will deal with inflation is by raising interest rates. And when the Fed is raising interest rates very quickly, like it did in 2022 or in the Paul Volcker period, you will see stocks and bonds become positively correlated, and it's bad for both of them for the most part, at least for the growth stocks. It's not as bad for the value stocks. But that is basically got a 2 or 3% chance of that happening in any given year. What was interesting about 2022 is it all happened in almost one calendar year. That if that had been spread over 6 months in 1 year and 6 months with another period, it would not have looked as dramatic as it looked. But that did occur in the late 1970s. It did occur in 1937, believe it or not. And it's a possibility, but it's not going to go on forever. And just because it happened doesn't mean it's going to happen again. In fact, it's an unusual event because you have to have both the inflation and the Fed reacting in that way.
Okay. It's important to understand history to understand these events because it may not be exact, but it will rhyme, and it has rhymed. And understanding historical perspectives, especially since we have recency bias of 15 years of a really long bull market, helps us prepare for what weather might be coming next and preparing ourselves. All right, catching up to Fi. This was the first of 2 episodes about bonds with Frank Vasquez. Went so long, we had to break it up here. And I urge you to tune in next week for the continued conversation about a misunderstood asset, I think, bonds and fixed income. See you next week.
So, Bill, as you know, we cannot do this show without our amazing staff and the people that help us put this on. Our editor is Fritz Brazard. We love them and they keep us going.
Yeah, Jackie, this show wouldn't have the quality it has without our folks, our peeps. And we'd also like to give you a few calls to action for the show. We love our community and we hope you love us back. If you would like to support the show and our mission to help late starters, you can do that at Buy Me a Coffee, which is a platform that allows you to make a donation. The link is in the show notes and on the website.
Check out the show notes for resources mentioned in today's show. Also, head on over to our website at catchinguptofi.com and check out our vetted resources, partners, and affiliates for discounts and their services because we love sharing great deals.
Please share the show with others and head on over to our Facebook community to help us grow. If you prefer video, head on over to YouTube and watch the show there. We hope you've enjoyed this episode of Catching Up to Fi. We would appreciate it if you could also leave us a 5-star review to help our message reach others.
And while we are financial educators that love to teach, remember that our content is for general education and information purposes only. We are not providing financial, legal, or tax advice. Always do your own research or consult a professional before making important decisions.
So, Jackie, we'll see our audience next time on Catching Up to Fi. Cheers.